Welcome to your complete masterclass on dividend investing. In the next 10 minutes, we are going to strip away the complexity of the stock market and show you exactly how to build a lifelong stream of passive income, starting with just $100. Most people wait until they have thousands of dollars to start investing, but that is a mistake. $100 today is more powerful than $1,000 5 years from now. It is the perfect seed to plant for your future financial independence. Dividends have been the secret weapon of the world's wealthiest families for generations. Since 1930, dividends have provided approximately 40% of the total return of the stock market, acting as a stabilizer through every economic storm. But what is a dividend? Think of it as a share of a company's success. When a business makes a profit, they can either reinvest it all or share a piece of that cash directly with you, the owner. That payment is your dividend. When you own a dividend-paying stock, you are a part owner of a real-world business. You aren't just betting on a price chart. You are participating in the actual earnings of a productive enterprise. This is passive income in its purest form. You aren't trading your limited hours for dollars. Instead, your money is working for you 24 hours a day, generating cash while you sleep, travel, or spend time with family. To be a master investor, you must understand the language of dividends. The most common metric is dividend yield, the annual dividend payment expressed as a percentage of the stock price. For example, if a stock costs $100 and pays $5 a year, that is a 5% yield. It's like the interest on a bank account, but with the added potential for the stock price to grow over time. Next is the payout ratio. This is critical for safety. It tells you what percentage of a company's total earnings is being paid out to you. A company paying out everything may not have enough left to survive a crisis. We look for the sweet spot, typically between 30 and 60%. This shows the company is generous enough to reward you, but responsible enough to keep growing the business for the long term. The most powerful factor is dividend growth. You want to see companies that have a consistent habit of raising their payments every year. This is your best defense against inflation and the key to true wealth. The true magic happens through compounding, what Einstein called the eighth wonder of the world. It's the snowball effect, where your earnings start to generate their own earnings. At first, the growth is slow and almost invisible. But over time, the weight of your reinvested dividends creates an exponential curve that can turn a small investment into a massive fortune. This is automated through a dividend reinvestment plan, or DRIP. Instead of taking the cash, you tell your brokerage to buy more shares. Over decades, this can result in you owning far more shares than you originally bought. Starting with $100 is only possible today because of zero commission trading and fractional shares. You need a platform that lets you put every single dollar to work immediately. Fractional shares mean you don't need $300 to buy one share of a high-priced company. You can buy $10 worth of 10 different companies, giving you a professional-grade portfolio on a beginner's budget. Diversification is your primary protection. With fractional shares, your $100 can be spread across various industries, from tech and healthcare to energy and finance, lowering your overall risk. For most beginners, the smartest entry point is a dividend ETF. An exchange-traded fund is like a pre-packaged basket of hundreds of the world's best dividend-paying companies. When you buy an ETF, you aren't betting on one company. You are betting on the entire economy. It provides instant global diversification for a very small fee, making it the perfect set-and-forget strategy. If you choose individual stocks, look for the Dividend Aristocrats and Dividend Kings. These are elite businesses that have raised their dividends for at least 25 or even 50 consecutive years. These companies have survived every recession, war, and technological shift of the last half-century while continuing to pay their shareholders. They are the bedrock of a safe, long-term portfolio. Start with sectors that are easy to understand, like consumer staples. These companies sell things people need every day, regardless of the economy, making their profits and dividends highly reliable. Utilities are another classic choice. We always need electricity and water, which provides these companies with very predictable cash flow that they use to pay steady, reliable dividends year-round. Healthcare is a third pillar. Large pharmaceutical and medical device companies often generate massive amounts of cash, allowing them to reward patient investors with growing payouts. Don't forget real estate investment trusts, or REITs. These companies own properties and are legally required to pay out 90% of their taxable income as dividends to you. Beyond the initial $100, the real wealth builder is consistency through dollar-cost averaging. This means investing a fixed amount every month, regardless of the stock price. When prices are low, Your fixed monthly amount buys more shares. When prices are high, it buys fewer. Over time, this lowers your average cost per share and boosts your long-term yield. One of the biggest mistakes beginners make is chasing hype. Stay disciplined. Dividend investing isn't about the latest meme stock. It's about the steady, boring reliability of profitable companies. As your portfolio grows, it's important to rebalance. This means selling a bit of what has grown too large and buying more of what is still at a good price, keeping your risk under control. You don't need expensive software to research. Use free stock screeners to look for companies with low debt, strong cash flow, and a history of dividend increases. Read the company's annual report. Look for a section called Management's Discussion to see how they plan to grow and protect the dividend you are counting on. Let's look at a realistic plan. Start with $100 today. Then commit to adding just $25 every single month. That's less than $1 a day. In just a few years, your small habit will create a portfolio worth thousands. Most people overestimate what they can do in a year, but underestimate what they can do in 10. The hardest part of this strategy is the patience. Dividend investing is slow at first. You must develop the discipline to stay the course even when the market is volatile. Ignore the daily noise of the news. If the company is healthy and the dividend is safe, a drop in stock price is actually a gift. It's an opportunity to buy more income at a discount. Beware of dividend traps. A yield that looks too good to be true, like 15 or 20%, is often a warning sign that the company is in serious financial trouble. A sky-high yield is often the result of a falling stock price. Always prioritize the safety of the payment over the size of the yield. Sustainability is the key to long-term success. Always check the free cash flow and debt levels. Dividends are paid from cash, not accounting profits. A company drowning in debt is at high risk of cutting your dividend. To maximize your wealth, use tax-advantaged accounts like a Roth IRA. This allows your dividends to compound and be withdrawn completely tax-free in the future. The goal of this journey isn't a bigger number in a bank account. It is the freedom to choose how you spend your time, knowing your living expenses are covered by your investments. Consistency is your greatest superpower. Whether the market is up or down, keep buying, keep reinvesting, and keep growing your share of the world's most profitable companies. Starting today with $100 is the greatest gift you can give your future self. Time is the only asset you can't buy more of. So start using it in your favor right now. Thank you for watching this guide to dividend investing. Start small, stay consistent, and let your dividends build your dream. Happy investing.